Hi, this is Dave Clayman. It's 12 o'clock on Thursday, June the 20th, and we're just about ready for the Make the Most of Your Investment Strategies webinar. Looks like we've got a few more people that are scheduled to join us, so I'm going to give it 2 minutes, and we will get started. So we'll talk to you in about 120 seconds. Thanks. All right, well, it is 12:02, and I think we'll get started with the June webinar. Thanks for joining us. So I'm Dave Clayman. I have with me Manny Frangiadakis, my co-founder.
Hello, everyone. Hope you're having a lovely afternoon, minus the rain if you're in the Boston area, but hopefully we'll provide some entertainment and some knowledge at the same time.
So this is Make the Most of Your Investment Strategies. For those of you who do or don't know me, I'm Dave Clayman. I'm the CEO of the firm and one of the co-founders.
I'm Manny Frangiadakis. I'm also one of the co-founders and an advisor here at 12 Points. So like Dave just previously mentioned, we're going to talk about making the most out of your investments, and looking at that is, what are the key drivers of financial security, savings rates. If you look across the board right now as a population, saving rates have actually declined, and when we speak to participants, especially in terms of financial planning, we really encourage them to at least try to put around 10% of their salary into some kind of savings vehicle. We know that can be difficult depending on your situation, but that's the magic number that we tend to see that makes a real difference, and it provides you the opportunity to put some money away and eventually, hopefully, put it in some kind of investment to work in your favor.
And one of the things, 10% does sound like a lot, and we often say even 10 to 15%. But if you think about it, you start working and saving at, let's say, age 25, and you want to retire at age 65. So you're going to work about 40 years. Your life expectancy now is into the 90s. So if you're a female, it's 93. If you're a male, it's 91. So if you're talking about living 25, 26 years on this retirement money you've built up, you're going to save for 40 and only put 10% away, but you want to live on about 70% of your money for 25 years, you can see why it needs to be not just 2 or 3%.
Yeah, the math doesn't add up that way. So you really need to be putting a little bit more into those vehicles to, give yourself the benefit towards the end of your lifetime. I mean, like Dave just mentioned, society is living a lot longer, and healthcare costs, we hope that someday they're going to go down, but if anything, they're only increasing. So you really need to make sure that you have a good buffer zone, so as you get into retirement and the later years of your life, you're not scrambling and trying to, pinch pennies together.
And the key, if your company is doing a match, you want to make sure you're at least getting that full company match. If they're giving you 50% of 6%, you put in 6, they put in 3, you're at 9 already. You're almost at that 10% level, so that's a good way to get started.
Mm-hmm. And as you can see, this is a really powerful slide. When we do when we do this presentation, when we first onboard 401k clients and participants, we start talking about, what's the power of compounding and the importance of starting as soon as you can, even if it's just a fraction, even if it's the first year of your being employed and you can't, get to that 6% level Dave was just talking about. But, even if you can just get to 1, the ability to start sooner is going to make a huge difference. And if you look at this slide right here, starting today, year 1, $6,196 in terms of putting into savings, and then waiting a year to get the compounding between year 1, year 5, and year 30. There's a big difference at year 30 between $609,000 and $563,000. And assume 500 monthly investment earning 7% annually. That's going to get you there. That's going to help grow your pot.
So literally being able to put away that $500 or that $6,000 in your first year, that ends up with a $46,000 difference at year 30. That's really a big number. It's probably an extra year's worth of your savings.
Absolutely. And where do you save? So obviously, if you're working with us, a majority of people have, 401k plans that we manage with the organizations that you're a part of. And most, companies are very generous and are providing some kind of match these days. So the importance of why contributions are pre-tax. If you're not putting it there, it's going into Uncle Sam's pocket. The money compounds until you withdraw. So what that means, as long as that money is vested in this vehicle, it's going to be working in your favor. There is no tax impact until withdrawal or retirement, and at that point, for most people, you're at a much lower tax bracket. So if you're not putting it away now, you're getting taxed at your full bracket. But, by putting it away and putting those tax-deferred savings into a 401k, when you do go to recoup that money, you should be at a very low tax bracket, making it very friendly for you, financially speaking.
So the other big piece, again, with the contributions being pre-tax, so it's a little less money out of your pocket. If you think about it, if you can only afford to save $50 a week, and you take those $50, if you put it into a post-tax vehicle, you're putting $50 in. If you put it into your 401k, you're probably putting more like $75 or $80 in. So you can imagine what a difference that makes.
The cost of delay. Due to dramatic effects that are realized through time and compounding of money, you lose more and more future retirement funds as you put off contributions. What are the reasons? Life expectancy is increasing, just like we said, the power of compounding and the impact of savings rates. This is just another key metric of showing why it's important to start as soon as possible.
And to what we already talked about, the increasing life expectancy, et cetera. So there are the numbers on that increasing life expectancy. You can see how many people are living to those ages, how long you're going to live. So if you make it to 60, you likely have another 20 or 23 years. You make it to 65, et cetera, et cetera. So you can see people actually getting to the point of living beyond 95. And it actually has become, they said the other day that the average person born now is going to live to be 105. Crazy, unbelievable. So Albert Einstein did call compound interest the 8th wonder of the world. What is compound interest? It's your money working on your money. So you put $5,000 into your 401k in a year. That $5,000 earns 5%. You've got $250 extra in your account. You're now at $5,250. Next year you earn 5%. You're not going to earn 5% on 5,000. You're going to earn 5% on 5,250. So the ability to earn money on your money, and to Manny's point earlier, not pay taxes on it annually. If that's in a taxable account, all those dividends and interest you earned, you have to pay taxes every single year. Mm-hmm. You don't do that. So again, increases that power of compound interest. Investing in 2019. So, if you happen to be reading the Financial Times, the Wall Street Journal, you have CNBC on in the background, or you're listening to Bloomberg or one of these other media publications that, specialize in the financial markets, you're probably going to hear a lot of jargon. And unfortunately, people in our industry do that on purpose to make themselves sound smarter. So a few things that you probably have heard is active versus passive. That is essentially what is active management. Active management is periodically and continuously looking at your investments, and whether that's individual equities or you're paying a manager to choose those investments for you. What is passive? That's essentially you're buying, the Spider's S&P 500 ETF, or even Vanguard ETF, or even just your target date funds. That falls as passive management. That means essentially you're riding the market. There's not much integral change going on there, and that there's a much lower fee structure. Mutual funds versus exchange-traded funds. That just shows how often they change. Exchange-traded funds are just like stocks. They can trade in and out multiple times during the day. And alphabet soup,
it's the same thing. ETFs, exchange-traded funds. CEFs, closed-end funds. FANG, those are your technology funds, Facebook, Alphabet, Apple, Netflix, and Google. IRA, individual retirement account. Most people, once they've already started maxing out their 401ks, they will look at adding an IRA or a possible Roth IRA, depending on how much you are earning in an individual year. There is restrictions depending on family income for Roth IRAs, but the way a Roth IRA works is the exact opposite of a 401k. You are not tax deferring. You are putting after-tax dollars into this investment vehicle, but the earnings and growth that you receive in that vehicle will essentially be tax-free because you've already paid taxes on those dollars.
So, yeah, and the closed-end fund, the only difference there, those are mutual funds that will trade at a discount. So potentially if you're interested in an asset class, you can buy a mutual fund that trades at a 10, 11, 12% discount. So that's a closed-end fund versus the traditional open-end mutual funds that you're more familiar with that just price once a day and try to price at their net asset value or what the underlying assets are worth. Warren Buffett's 2 rules of investing. Boy, most people have forgotten these ones. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. What does that mean now in this environment, Manny?
What does that mean, never lose money and don't forget rule number 1? I honestly believe at this point in his career, and what he's saying is don't chase the market. I think that at this point in time, so Warren Buffett was, he was the father of value investing. He believed in buying distressed companies that weren't attractive. He believed in being fearful when others are greedy and being greedy when others are fearful and taking advantage of opportunities. What never lose money is do your homework, do your research, and pick an investment that you think is suitable. And kind of wait till you see the whites in their eyes when you pull that trigger, giving yourself an optimal opportunity to have a good ROI on your investment.
And I apologize, I just saw the question. Thank you for tossing it out there, that the screen wasn't getting shared. I apologize for that. That's completely my fault. So hopefully this was still informative. We can go back and take a look at some of the other slides real quick. Give me 1 second here. We're going to back up just a little bit and see if there's anything. So very quickly, our pictures, very nice. We talked through the key drivers of financial savings, financial security, and savings rate. There's the visual that really you probably missed of anything. That key of in the first year, if you're saving $6,000 or $500 every month versus waiting 1 year, here's how much money you have after 5 years, here's how much money you have after 30. So you can see that big difference. I apologize you weren't able to see that earlier. We talked through contributions being pre-tax, not a lot of visual there that you would have missed. Life expectancy increasing, we can see how many people are living past certain ages. And then our friend Mr. Einstein, I'm sorry you missed his great hairdo with his compound interest. And then now we're back to that where we were. So apologies for that again. Here we are. So boy, I will definitely say people have unreasonable return expectations. Having been blessed with a bull market for the last 10 years in which the market has quadrupled, people think that stock, markets go up 10, 12, 14%. I will say it was a big shocker in December for people who had target date funds or index funds, especially target date funds. They didn't realize they could go down. I got a number of calls. Unfortunately, the Vanguard target date funds, as good as they are passive, so they ride the market wave. They were down 12 to 14% in the month of December. They bounced back now, but just being mindful of what a good return expectation is. You basically make money over the long term based on where you buy things, not where you sell them. So being able to buy with a margin of safety. Right now, markets are high. Can they continue to go higher? Absolutely they can. But just being mindful of where you are in your career and your investing life. If you're young and you have another 30 years to go and you have a stoic outlook on the world, maybe you're not going to mind if the market goes down 15, 20%, because you're going to be continually investing, and that way you're buying more shares in your 401k at discounts. However, if you're late in your career and that time is, whenever we do a financial plan, and we may have done some with you, the worst thing that can happen is a big drawdown right as you're retiring because you're no longer adding to that pool of money. So just being mindful of that. And you could see, Manny touched on, look at these numbers for what people expect for return.
51% believe that they can do better than a 10% return. 10% return in our minds is a pretty good year. We'd be very happy with generating 10% returns. Unfortunately, the fact that 21% think they can do better than 20%, I think just that tells you that we're pretty late cycle in this market. And people, to Dave's point, don't believe that things can go down anymore. Unfortunately, that is very much the case. Just as much as they continue going up, they can certainly reverse course.
And I think one of the things you'd see here, professional investors are expecting U.S. stock returns to be in the 5% range and a 60% stock, 40% bond portfolio returning in the 4% range. So you can see only 21% of people total believe you might be in that range. I think that's the safe area to be thinking about.
Yeah. And to Dave's point, I honestly do believe it depends on where you fall. Where are you in your life cycle right now? I mean, if you are just starting out and you're in your 20s or 30s and you're continuously putting in there, you can be more aggressive, because even if you do get a 15% correction, your dollar cost averaging into that investment, and eventually, do markets correct? Absolutely. But do they come back and at the same time go and make new all-time highs like we did today? Absolutely. So it's just being mindful of where you are. At today's point, if you are at the end of your working career and you're in retirement and you're not adding to that pool, you need to just understand what you need to make your financial plan work. If you only need a 3 or 4% return on an annual basis, then your portfolio needs to be structured that way, because you cannot afford to take an 18% drawdown in those time periods.
And boy, is the economy giving mixed signals right now. The economy is, the Fed is, everybody is. So tailwinds, what's going on that's good? We have low interest rates. The Federal Reserve has interest rates set at 2.5%. They gave an indication yesterday that they may even decrease those. Mortgage rates have absolutely plummeted over the last month. Mortgage rates are down almost a full percent over the last month. So there's one thing taking advantage of your opportunities. If you're in a position where you could refinance, taking your 30-year mortgage down to a 15, this would be a great time and a great opportunity to do that. So take a look, see where you are. But if you don't have a ton of closing costs, then that's a good place to look. And if you have questions about those kind of things, you can always reach out to us via the Rapid Review, and one of our certified financial planners can help you walk through that. Growing dovishness in central bank policy. So that might be a financial jargon term you're not familiar with. So doves versus hawks. So a dove is a very friendly bird. They tend to lower interest rates. A hawk tends to attack. They're raising interest rates. So this dovishness, this idea that all the central banks in the world want to provide more money, that's called dovishness. And we are seeing it out of the European Central Bank on Tuesday, out of our central bank yesterday. Continued positive earnings growth environment, and that's slowing down a little bit. So not as much as we've seen. We actually had negative earnings growth for the last quarter that came out overall. And then we are seeing positive household consumption. Definitely, business investment activity has been slowing a little bit. So that's kind of the tailwind side. Man, you want to hit on the headwinds?
Yeah, and I want to add two things on the tailwind. So growing dovishness in central banks. Think of that as a punch bowl. Think of it as the stock market as the party, and the punch bowl is what they're doing with interest rates. By lowering interest rates, they're refilling that punch bowl. They're saying we're going to keep the music going and we're going to keep the party going. When the Fed hikes interest rates, they are taking away the punch bowl. They're saying we're taking, there's too much exuberance. Corporate debt has exceeded expectations. We've left interest rates too low and people have taken too much advantage of the opportunity. We need to tighten financial conditions to protect ourselves, and usually that is to fight off inflation. So just think of it as a punch bowl. And then continued positive earnings growth environment, yeah, but if you take a look at what corporations have been doing, we beat 78% of companies beat in the last earnings report, but at the same time, they've lowered guidance before every single one of these earnings reports. So they're beating their earnings estimates, but the earnings estimates that they're pinpointing are pretty weak, comparatively speaking. So over to headwinds. Global populism. What is global populism? Global populism is essentially what's going on right now between the G20 and the G8. It has never been a more unfriendly environment than we have really today. Essentially, it's one nation against all other nations. It's the U.S. Putting itself on an island and saying that this isn't a global economy of highly networked corporations that, trade a lot. It's essentially, our economy is our own economy, and it doesn't matter what the rest of the world is doing. That is essentially global populism. Weakening business and consumer sentiment. If you look at what businesses are saying, if you're listening to what CFOs are saying on conference calls, they are actually looking at business conditions worsening. They are highlighting the fact that costs are going up and consumer spending is going down. So that will be a negative to the economy. Concerns about slowing in the U.S. and other major economies. This is definitely happening. We are growing at a much slower rate. I think, GDP right now, I think we'll be lucky if we can get to 2 to 2.5%. I don't believe we're going to be growing at 3%, and I most certainly do not believe that we will ever grow at 6% like President Trump thinks that we can do, especially if we lower interest rates. Anti-trade and anti-immigration policy sentiments. We have ripped up all of our trade deals in the last couple of years, especially with this administration. NAFTA's gone. We are fighting with our largest trading partner, China, and that does not seem to be moving in a positive direction. Certainly things could change, especially with the G20 meeting at the end of this month and President Xi and President Trump getting together. But, the trend is not in our favor. Global trade is slowing. The amount of goods and services that are crossing borders has decreased. And, one point to consider, and this has been a famous quote, is that when goods and services no longer trade cross borders, armies begin to. So that is a very negative thing that is possibly heading in the market's direction. Currency volatility, what does that mean? With everything that's going on right now with central banks, people are financially manipulating and keeping their currencies very low, making it much easier. But at the same time, you'll hear a lot of people saying that the dollar is very strong right now. That is a negative for our economy. That means that we are exporting less goods because the dollar and the cost of our goods are higher than other places in the world. So as we export less to other trading partners, that will lower GDP. And rising geopolitical risks. We had just this morning, Iran shot down a U.S. drone. We had a tweet come out a few hours ago or a few minutes ago that, Trump is saying this is very bad for Iran, that they will regret this. There are rising tensions between here and the rest of the world. What's going on right now in the Middle East, especially with the Strait of Hormuz, of talking about possibly closing that down. That is a very negative geopolitical tension. So right now, tensions are rising at a time where earnings and growth are decreasing. That will be a market headwind.
Right. Well, the U.S. stock market is overvalued. Pockets of opportunity remain. So I think that's something to be mindful of. There are more sells than buys in most sectors. So this is Morningstar. The red is their one-star ratings. You can see a lot of those. Their orange is only their two-star stocks. Yellow 3-star, green 4-star, and then the very few blue, those are their 5 stars. So you can see it's pretty hard to find attractive things. Healthcare, certainly out there. If interest rates are going to be lower, utilities had a good day yesterday. That might be something to be looking at. Be mindful of what you're buying, but you've got some 4-star opportunities there. I really do think that individual stock picking is going to be valuable to you. Obviously, you can't be doing that in your 401k. But on your other investing, but looking inside your 401ks, again, just being mindful of where there's value out there. If you're working with us in our models, you're looking at a lot of international investments over U.S. They are more attractive. They do seem to be providing a better opportunity there.
Yeah, and I think to Dave's credit, to Dave's point, I think individual stock picking and in particular active management is going to come into favor over the next couple of years. I think that you're probably looking at some point in time negative returns in the U.S. stock market. We will have a recession. There will be a slide coming soon that shows what the recession expectations are over the next 1 to 5 years. But being invested in utilities and in particular getting invested in companies that pay a good dividend is what's going to save your account in your portfolio in a negative environment. So you'll slowly start to see now, as things ratchet up, people will start to transition out of these high technology, high growth companies, the FANGs of the world, and they will go back to the blue chip dividend paying stocks that will give them some kind of benefit in an environment where stocks possibly have negative returns. So the yield curve inversion, there's another term you may or may not have heard. Typically foreshadows recessions, but not immediately upon inversion. So what does that mean? It's when the long-term interest rates are lower than short-term interest rates. The easiest way I think about this, if you were going to loan somebody money for a month, you'd say, give me 2%.
If you're going to loan somebody money for 10 years, you're going to say, give me 4%, give me 5%. I want more money for loaning you money longer. Well, right now, short-term interest rates are higher than long-term interest rates. Why is that? That is the market, that is the bond market telling you that interest rates are too high in the short run and that the economy is likely to slow down, which will cause interest rates to get lowered. Now, the Fed confirmed some of that yesterday. So that's foreshadowing that potential recession. But it doesn't happen right away. You know, we had a quick sell-off back in May when we first inverted because everyone said, oh my God, the curve's inverted, we're going to have a recession. Okay, but it doesn't happen quite that instantly. The bond market's smart. It's not that smart. So it foreshadows it. But you can see some of these returns when you've had the 10 and 2-year curve inversion starting. So starting December of 05, you know, we had a 57% loss in the S&P from peak to trough. Do I think it's going to be that bad? No. But you can see some 17s, some 20s, some 13s. So, and typically that lag is 16 months between the time when the 10-year interest rate is lower than the 2-year interest rate. So,
yeah, and again, you know, this is artificially created and manipulated with, you know, what we're doing as central banks. It's pretty crazy to think that, you know, in an environment like this where we have the Fed funds rate at 2.25, 2.5 possibly, that, you know, the real question is when you do get a recession is what's the next round of ammunition going to look like? Do we possibly go into negative interest rates, which is a crazy phenomenon? Most people don't realize right now that, you know, the Swiss bank recently, earlier this week, raised money. And they are essentially raising money, and because they have negative interest rates, they're borrowing money and they're going to pay you back less than what you're giving them in 30 years because of negative interest rates. Same thing as a mortgage. Think about it. If you take a mortgage out in Norway and you have negative interest rates, you are actually receiving a check for living there because of negative interest rates. So it's just keep in mind that a lot of this yield curve inversion right now is getting financially manipulated.
That's it. I'm moving to Norway. I like the idea of getting paid to live in a house. All right. So what are our concluding thoughts? So institutional investor survey results, where are bubbles brewing and when will the next crisis hit? So you can see here, both overall and in all the different regions, where are those bubbles brewing? So 60% of institutional investors believe there's a bubble brewing in cryptocurrencies here in North America, 51% in the tech sector. Now those are generally the largest stocks in the S&P 500. So if you're in a passive market, 51% of institutional investors, according to Texas, are telling you you've got a bubble brewing in the largest sector within the S&P 500. So something to think about, maybe switching passive to active. The stock market in general, 35%, bond market, 31%. So great. We've got both stocks and bonds potentially in a bubble. Where do we go? Mm-hmm. That, again, reach out to us. Those are some things we offer, some other funds that might provide you a good, safe place to hide, so to speak, if some of these things come true. Again, not with your whole portfolio, but just taking a portion, you know, taking some chips off the table, so to speak. Real estate, 34% chance of a bubble. China, a 24% chance of a bubble. And then 15% of people think some of the above. So they could turn out to be right.
Yeah.
So that's why you never do it with the whole portion, but just being careful. And then, Manny, if you want to talk about the recession part.
Yeah, so what does that mean right now with the recession? This is what it's telling you, that institutional investors are pricing out when the next possible recession is going to hit. And a lot of this obviously comes back down to the yield curve. So 6% think that we're going to have a recession in less than a year. 64% believe that a recession will occur in between 1 and 5 years. Now that's a pretty, you know, big time period, 1 to 5 years, especially when you look at the fact that we're at the second longest bull market in history. I would assume that, you know, that's just within 1 to 5 years, you know, at some point, when does the music stop and at what point do we have some cooling going on? 11% believe that it will occur within 6 to 10 years, 10% in over 10 years, and 9%, I don't think there will ever be another global financial crisis. Maybe the Fed has it all right. Maybe they have all the pieces of information that the rest of us don't have, and they think that they've essentially removed the possibility of a financial crisis. We don't believe that to be the case, especially if you look at what's going on with the corporate debt market, the high yield market, and even just our own fiscal deficits.
So it's funny, if you ever hear that, if you ask somebody if they're a better than average driver, 75% of people will tell you they're a better than average driver. Obviously, you can't have more than 50% that are better than average. So right there, I'm shocked that the 64% in the 1 to 5 year category, I would have thought that would have been like 90%.
Right.
Because if you're so brazen to think that you can break more than 5 years out, you're a better person than most.
Right.
So anyway, that's, I would personally put myself in that 1 to 5 year category without any trouble.
And I also think that we have the wrong, we have a misconception about what is a recession. You can have an earnings recession, you can have a stock market recession. It doesn't mean that the global and the U.S. economy is going in the gutter and that people are going to lose their jobs. Recessions, in my mind, are healthy. It's how you clear the system. Right now, you'll hear, and especially when we do get, the next recession, you will hear a lot of jargon about zombie companies. These are companies that essentially should be bankrupt at this point in time, but due to artificially manipulated interest rates, they are allowed to survive, which is taking prosperity and growth that should be going to other companies and spreading it to companies that really shouldn't be in existence. So by clearing out the system, you're actually making it healthy. So in my mind, recessions are healthy. It's part of the cycle. It's what gives the opportunity for that next leg and that next move higher, and for productivity to increase.
If you know anything about how trees grow, I think that's a good example for a recession. We need to clear the brush out so that you can get the sun through for other trees to get that sunlight and regrow. That's what you need. You need that clearing out. And so we'd love to see, we think you'd have better long-term opportunities for investing if we could get a good, solid recession and clearing. We're not looking for the great financial crisis. Banks are not going to go bankrupt. This is not that world. Just a nice, healthy, let's figure out who's a healthy company, let's figure out who's not, and let's be there, and let's get some opportunities for good investments at reasonable prices. So overall message is we're probably closer to the end of something than the beginning of something. Just make sure that your portfolios are where you want them to be. If you have any questions about that, reach out to us. Our contact info is right here. That would be an opportunity for us to have you take a risk questionnaire, see what how your risk personally lines up with your portfolio, get all those things squared away, and just be cautious out there. Don't be panicky either on the upside or the downside. Keeping a level head is the safest way to invest, in my opinion.
Absolutely. And to Dave's point, one of the other things that we could definitely do for people is stress test your portfolio. We can give you perfect examples of how your portfolio would perform in comparison to all the other past crashes, and at the same time what future crashes or potential crashes would do to your portfolio. So we're happy to stress test it and show you what those numbers look like and allow you to make the best decision. And don't act irrationally. Money is a very emotional topic. When people, we had people that we spoke to back in December when the market dropped 17%, that sold out there. That was the wrong thing to do. You just took your medicine. At that point in time, we knew that it was overdone and the market was going to come back. Don't act irrationally. Just take a breath, take a step back, depending, especially on where you are, especially if you have a long-term horizon, and just, let things sort out. Don't make rash decisions. Eventually, yes, markets will correct, but they do also return back to where they were, and if not higher.
So it doesn't look like we have any additional questions at the moment, so we appreciate your time. If you do have any questions, there's our contact info on the screen now that you can actually see it. Mm-hmm. Both of our email addresses and our phone numbers. We're here to help. This is what we do. We love talking about the markets. This is actually, of all the webinars I get to do, this is my favorite topic. So please reach out, and we're here to help. Tell your coworkers as well if this was helpful, and we look forward to talking to more of you at next month's webinar in July about organizing your finances. Have a great month, and we'll talk soon. Take care.
Take care. Thank you.